Hello, everyone. I'm Ethan Astonay, Financial Advisor at Nicola Wealth. Welcome to today's real estate webinar, a mid-year update and why 2020 is looking up. Today, our guest is Mark Hanna, Director of Real Estate at Nicola Wealth. Mark works closely with our 32-member real estate team, and together they manage the various aspects of our in-house real estate portfolio, including in areas of asset management, finance, acquisitions, leasing, mortgages, and property development. I present on behalf of the real estate team today and give an update on our three in-house funds: the Nicola Canadian Real Estate LP, the Nicola US Real Estate LP, and the Nicola Value Add Real Estate LP, which some of you may know formally as our Spire Real Estate Funds. Mark, thank you for joining us today.
Glad to be here.
So we're just going to jump right into it. The Q2 reports were recently sent out. Maybe to get us started, you can give us a mid-year update for the three funds that we manage.
Sure, happy to do that. And I believe for this question, we have some slides for our audience to help follow along. Let me first start with our Nicola Canadian Real Estate LP. This is our core income fund for Canada. It is probably the most diversified of the funds by asset class and major markets. It includes industrial, multifamily, rental apartments, single-story flex office, self-storage, seniors independent living, and a very small amount of retail. We have 60 plus properties with a very low debt leverage of ratio of 41%. The return for Q2 was 1.0% year to date. While that might seem low, rent collection was actually very high, but the valuations were impacted. We are still projecting a 4 to 5% total return for 2020 for this fund by year end. Next is our Nicola US Real Estate LP, and this is our core income fund for the US and is actually the largest of our three funds with a total of 1.9 billion in US dollars. It is also diversified, but in a much different way than our Canadian income fund. It includes industrial, creative office, and a small amount of retail, which is predominantly situated in Western US markets such as Seattle, San Francisco, Denver, Phoenix, Las Vegas. However, the US fund has a much larger allocation to multifamily rental apartments, which is about 57%. And most of these are your garden style apartment complexes, and they are located in the South and Southeast states in very tax-friendly locations such as Texas, Florida, South Carolina, and Tennessee. This fund in total has 85 assets and has a debt leverage ratio of 50%. So and when you compare that leverage ratio of 50% to the Canadian of 41%, some of you may wonder, why is it higher? It's because we have a much higher allocation to multifamily residential, and typically with multifamily, because it's viewed as the safest asset class, you get a much higher leverage. And that's why the ratio is a little bit higher. The return for Q2 was 4.4% year to date for 2020, which is very good under the circumstances. Rent collection was also very strong for this fund. And we are still projecting conservatively a 7 to 8% total return for 2020 by year end. And finally, our Nicola Value Add Real Estate LP. This is our value add merchant fund, meaning that all the projects in this fund are either build to sell or repurpose and sell. This fund is well diversified by asset type and geography. It includes industrial strata condo, industrial for lease, office strata condo, office for lease, multifamily rental apartments, and some residential condo and retail repurposing. This fund operates in both Canada and the US and has a large concentration in Vancouver, but it also has coverage in Toronto and other certain markets in the US. In total, we currently have 45 projects, and with several more in the pipeline. The debt works much differently in this fund, where we either have a land loan or a construction loan, and that will depend on what stage of development the project is at. In most, but not all instances, we typically will JV with a development partner who has a specific skill set in certain market or asset class. The return for Q2 was 7.1% year to date for 2020, which is also very respectable. And we are still conservatively projecting a 8 to 10% total return for 2020 by year end.
Thanks for that update. Since the start of COVID in late March, perhaps the common question we received was with relation to rent collection. And the rent collection in the two income funds appears very strong. So can you please provide some insight into why that occurred?
Yes, Ethan, you're right. Rent collection was and still is the number one question we get asked constantly. But so the rent collection I'm going to talk about really only applies to our two income funds. For both the Canadian and US income funds, we have achieved 97.5% rent collection through the first 5 months, being April to August, since the start of COVID. This is even higher than what we originally reported in our last webinar in May. I must admit that our Nicola Wealth team and myself, we were not looking forward to April 1st. We had no idea how our real estate funds would perform, and there was a lot of uncertainty and anxiety by myself and our team leading up to that first month. I think we were bracing for the worst, but to our surprise, the funds performed very well. But it wasn't easy. The rent did not all come in on April 1st. So what we did is early on, prior to April 1st, we assembled a SWAT team internally to specifically deal with this event. And so what we experienced was there was a lot of hesitation in that first month by tenants who didn't want to pay their rent on time. And most of these tenants were very capable of paying their rent, but the hesitation by the tenants was the concept of conserving capital due to the heightened level of uncertainty in the foreseeable future. Fortunately, almost all of our tenants did the right thing. They paid the rent, so for which we're very thankful. The good part about the COVID environment, if there is such a thing, is that it resulted in a greater level of communication that has led to a strengthening of our relationships with our tenants. There's a lot of heavy lifting that's done by our asset management team, and it all starts with strong communication and relationships with our tenants. And as I've stated before, the payment of rent by tenants in a timely manner on the first of the month is often taken for granted, but rent collection, it underpins the thesis of real estate investing, as it enables landlords to operate and maintain their buildings in a professional manner, which is expected by the tenants. But more importantly, it ensures landlords can pay their operating costs, property taxes, insurance, their mortgage obligations, and of course, distribute cash flow to investors.
So while rent collections was strong, the team still did provide some deferrals to some of the tenants in the portfolio. Have you started to see the recovery of that rent? And do we expect any bad debts there?
Firstly, I want to clarify that it's important that a deferral does not mean a default. Rent deferrals granted were done so on a case-by-case basis after our SWAT team talked to those tenants who were hesitating, and then we had to sift through which ones truly were eligible for a deferral. But they were designed to recover this deferred rent over a future period of, say, 6 to 9 months in the future. And that period has already started. So within our $4 billion plus real estate portfolio, I think we were very fortunate that we had to grant actually very few minimal rent deferrals to tenants. The rent deferrals we did grant were then amortized over future rent payments. most of those tenants are already paying back the deferrals. In fact, we had a team meeting this morning, all hands on deck, and that topic came up, and we are tracking it. And to my surprise, some tenants have actually paid back all their deferral instead of amortizing it over the rent. They've paid it up front. So again, we're very pleased and happy with that outcome. So while we anticipate there's still going to be a small amount or a small percentage of those deferrals that we granted that may be written off, it's going to take several months, well into next year, to actually to play that out and determine the outcome. But the early results are suggesting a very positive outcome on the rent deferral recovery. So in summary, while it'd be easy to attribute our great rent collection results to our strong fund composition, there's no way we could have achieved this without these favorable results under these extreme circumstances, unless we had a talented group of people on our Nicola Wealth Real Estate team. They were in the trenches, and they were forced to have very difficult conversations with our tenants while maintaining those relationships. So we're fortunate with this result. And I believe through this experience, our Nicola Wealth Real Estate team has continued to grow and from this learning moment.
Thanks for that. So, the rent collections being one component of the return, another key component is the market appreciation. So can you explain to our investors a little bit about how appraisers in this environment have adjusted their process?
Yeah, that's another very often asked question, how we value the fund. And so Q2 of 2020, this was the first full quarter where the full impact of COVID-19 could be measured. We recently made the decision to change the rotation of our appraisal format for our income properties. So previously, each property was appraised annually with approximately 1/12 of the portfolio appraised each month in order to stagger the valuations throughout the year. However, whether it was a coincidence or not with COVID, we were pretty much trending that direction. But effective April 1st, which was the start of Q2, we implemented a new appraisal policy whereby each asset will be appraised once per quarter, whereby approximately 1/3 of the portfolio is appraised each month in order to capture the entire portfolio over that quarter. So we've just gone through that process. We adopted this process to ensure that the values reflect the most current market information available to appraisers and to be consistent with other large institutional real estate funds. The COVID environment, it's presented numerous challenges to real estate, including rent collections and changes to the landscape for property transactions. During COVID, initially, the transactions slowed significantly, but it's now starting to ramp up. So it's very difficult for appraisers to find those sale comps to benchmark to do their valuations. However, for Q2, the appraisers were definitely challenged on obtaining these market comps. Overall, rent collection has been strong for Q2, but it's been dampened by a softening in certain market valuations stemming from a more conservative cash flow and market growth assumptions applied by the appraisers. We call these the COVID factors that the appraisers are applying. So for example, they might apply these COVID factors. It might be a higher vacancy allowance than normal, or a higher reserve for capital expenditures, or for improvement allowances, or on rollovers with tenant renewals. So those are higher than normal during this time frame. Other factors that also impacted valuations include either geography or asset class. So in the case of, say, geography, even though we're basically 100% rent collection in all of our Alberta assets, we were still penalized on the cap rate by the appraisers by the mere fact that the Alberta's economy is suffering. Another example would be, say, asset class. And this would be, say, retail or hotel. We don't own any hotels, thankfully. We do own a very small percentage in retail. And it's been noted in the media how difficult it's been with retail tenants in enclosed malls. So again, even though our retail assets have performed substantially above the benchmark, appraisers have still penalized this asset class with higher cap rates, at least for the short term. And so fortunately, the bulk of our portfolio does not include retail. It's made up of industrial properties, multifamily rental apartments, creative office buildings, self-storage, and seniors living, all of which have performed above the benchmark and have not experienced any material impact on valuations. So our anticipation is, based on the numerous conversations we've had with appraisers, once this COVID environment stabilizes, it's our understanding that these extra COVID factors will be removed and will return to a more normal valuation methodology.
Thanks for that. You mentioned earlier the challenges of approaching April 1st and the uncertainty. So over the last 5 months, can you outline how the team managed cash flow, forecasting, I suppose, with all of this uncertainty?
Yeah, that certainly did keep me up at night, is initially the cash flow. So over the past 5 months since the start of COVID, which really was, call it April 1st in terms of rent collection, there has been definitely an increased attention to the cash flow forecasting by our Nicola Wealth Real Estate team. There's a lot of complexity involved in running operating our 3 evergreen open-ended real estate funds. If you think about this, you have these are the things that are going on in that fund. You have your property cash flow, you have operating costs that you're paying, you have property taxes, you have insurance, you have mortgage commitments, you have new capital, you have redemption requests, you have property financing, and of course you have distribution to investors. So as you can imagine from the above, there's a lot of moving parts when we look at these cash flow forecasting, which we do weekly. So during our last webinar in May, we were only 2 months into COVID at that point. And we reported that we plan to adopt a very conservative approach and not make any major decision on acquisitions until we can get better visibility on how our real estate funds were going to perform. So for example, I didn't want to, if rent collection had dropped to 70%, that definitely would tell us that we should hold off on any future acquisitions. And that of course did not happen. We were unclear on new capital and redemptions, but again, we were pleasantly surprised at the confidence shown by our current investors and new investors who have come in since, who did not redeem. Plus we were recipients of new capital from new clients that have come to the firm. What possibly helped with the lower redemptions is the fact that we made our Nicola Wealth Real Estate team directly accessible to our clients in those early months. There was a lot of anxiety, a lot of uncertainty, and they wanted to hear from us directly. So we provided them feedback on what we were doing and hopefully comfort on what our activities were to ensure that these real estate funds performed as normal as possible. So fast forward to today, 5 months later, I'm pleased to report that all 3 real estate funds have performed as normal as possible. And thankfully to our valued clients who share the same vision for real estate, which is a patient, long-term investment horizon, our funds were built to be reliable and stable, and therefore that requires patient capital for a long-term benefit. And then my last point is the strong rent collection results experienced over the last 5 months since COVID has provided the visibility and the confidence by our team to move forward with new acquisitions. And we are now seeing an incredible amount of volume of opportunities. And so we expect Q3 and Q4 to be very active, but we will continue to be very disciplined.
Great. You mentioned we talked about the strong results on the rent collection side. Can you speak a little bit about the importance of fund composition and, what we learned that will help us go forward, knowing that we benchmark the results for our two income funds to the investment property database, which allows us to gauge our performance on a relative basis. So can you answer those and maybe let us know how our funds have performed to those benchmarks?
Sure. And I think we have slides in this section that we'll put up in a second, but I wrote on this very topic of fund composition a few months ago, and it's posted on our website called Fund Composition. We always knew that fund composition was important, but we never before, that statement has never been more true now that COVID has commenced in Q2 of 2020. April 1st was a very cruel date to have our first test for rent collection. There was no time for jokes. We were bracing for the worst, but obviously hoping for the best. Fortunately, as I stated earlier, our rent collection results are above our expectations, and we have to credit a big part of this credit goes to, I think, how our funds were built and designed. Our approach was always from day one, was let's try for singles and doubles that might turn into triples and round trippers. But we never want to stretch too far on any one particular deal or a borderline asset that might move the needle in the wrong direction if it didn't work out. So we've stayed true to this disciplined approach. And over the years in building our three real estate funds, we never planned for a global pandemic, and I'm not sure anybody did. But notwithstanding, the data points we've collected during this COVID environment, they've been extremely valuable. It's given us a lot of good information and data points. It's not only reinforced that we adopted the right discipline and the conservative approach, it certainly reinforced that, but it's also helped to highlight the asset types and the geographic markets that we want to pursue going forward. And there's not a lot of tweaking we have to do, but there are some minor tweaks. But this certainly was an unplanned stress test of significant proportions. But it's also important not to forget that people also make a difference. And I know I keep saying this, but our Nicola Wealth Real Estate team, we got 32 people on our team, they played a vital role in achieving these rent results. So now I think we're going to put on the screen here. We subscribe to IPD, which helps us benchmark our income funds and our performance against the competitive set. And so at the top, we have our Nicola Canadian Real Estate LP. So for Canada, you'll note that our ranking shows that we're kind of in the middle of the pack in the benchmark. So that's a couple of reasons. A substantial amount of the acquisitions in the last 12 months, they'll have negative returns because there's upfront cost to acquire and there's no appreciation to date. The other thing is 6% of our portfolio is in build-to-own projects where we are not realizing the full expected future value, and therefore there is an interim drag on the cash flow. But once those are completed, they're going to be very complementary to the fund. And then the last point is we still like Alberta. We want Alberta to prosper, but the fact is, even though we have basically 100% rent collection in Alberta, our fund has 22% allocation in Alberta. And that, as I mentioned earlier, we've been hit with unfavorable cap rates by the appraisers. So for the U.S. income fund, this obviously we've performed extremely well, basically at the top of the benchmark. And there's a few reasons why. Almost all of our asset class returns are surpassing the benchmark, and with retail multifamily far surpassing the benchmark, which has certainly helped with our returns. And the income return is the first among participants, which is confirmed with our extremely strong rent collection results at over 95% since the start of COVID. So those have definitely helped the performance of our U.S. income fund. And I think too, we have a large allocation to the multifamily being 57%, and that portfolio has exceeded our expectations.
Thanks for that, Mark. Exceptional result. Maybe we can talk a little bit about financing, which is another important aspect of, providing the attractive leveraged returns our investors. Can you outline a little bit about what you and the team have been able to achieve front since the start of COVID and how that impacts our funds?
So I think you're going to have, or we have some of the financing on the screen here that we're going to put up. Yeah, so we have, there's several components to our team that help to contribute to the fund. So we have financing is a big part of that. So I just put up on the screen here 6 examples of financing, and I'll just go through them quickly. So starting in the top left, we have the Hat at 5 Corners in Edmonton. It's a new concrete high-rise. We secured favorable new CMHC financing at 1.15%. So that was very attractive. Going across the top, we have an industrial distribution building. We also just did a blend and extend on that property with our lender. Over on the far right on the top, Enerflex building, we negotiated a new 10-year extension with that tenant, which then set us up to go back to our current lender to do a very attractive blend and extend. On the bottom left, we have the Nickel, which is a new creative office building that we just completed in the Mount Pleasant area of Vancouver. And this is in our value add fund, but we took out our construction financing on completion when it's now 100% leased. We got very favorable long-term financing for that asset. In the middle on the bottom, we have Interurban Crossroads, and this is also in our value add fund. And we have, this is our industrial strata project. We like this product a lot. We have or are in the process of doing 10 of these types of projects, and we got very favorable construction financing. And then finally, on the Clyde in Port Moody with our partner, this is Strata Residential, and we just finalized financing to start the construction once we've hit our pre-sale targets.
Thanks for that. So, leasing is also a very important contributor to getting cash flow for the funds. So can you describe the leasing velocity in general and the willingness of tenants to transact in an environment like this?
Sure. So we've got some examples on the screen here. And again, similar to financing, leasing is obviously very important because it affects the income for the property, and you want to make sure that you have high occupancy in your portfolio. So what we've done here is we've given a few examples of some recent lease transactions, which is amazing given this environment, because a lot of people were wondering, including us, were tenants prepared to transact in this environment? And to our delight, they were. And even in all these transactions have essentially happened in the last quarter. So let me just go through a few of these. We have one in North Service Road in Oakville. And so this is a new build to suit, 40,000 square foot building we're doing for Spark Power. And that's a new 15-year lease. So that'll be starting construction shortly. In the middle on the top there, and again, these 3 are in our income fund. This is Dover Point, which is in Nanaimo. It's one of our very few retail assets. We renewed Winners and HomeSense, both expansion and extension on the lease term for 15 years. And in the far right at the top in our Canadian income fund, we renewed a distribution tenant for 76,000 feet. This is a new lease, and that center has performed very well for us. In the US income fund on the bottom, we have one of the very few office towers, probably the only office tower we have in Chicago, and it's the only asset we have in Chicago, and this is very close to the O'Hare Airport. And we just renewed for 11 years our largest tenant in that building for 141,000 feet. We're very happy with the terms. They're a great tenant. So that significantly de-risks that asset. In the middle, we have, again, one of the very few retail assets that we have in the US, and this is a power center, South Hill Village in Puyallup, just south of Seattle. And we renewed this tenant for 52,000 feet for another 10 years. And then the last one on the bottom right, this is in Seattle, and you can see in the background of that picture there, it's very close to the Seattle Seahawks Century Field Stadium. And with the tenant, people laugh, this is corrections. This is the US Corrections Department, where people go for their parole. We renewed them for 40,000 feet in this building, and they've been a great tenant. And these times, it's nice to have government tenants because they pay their rent on time.
That's great. Thanks, Mark. It's very helpful to see those examples like that. Switching gears a little bit, the real estate team has made what seems to be a concentrated effort to develop more properties or build to own for our income funds. Can you explain why this is an important piece of the strategy for those funds?
Sure. I think we also have some examples on the screen for our audience here. We made a strategic decision in 2018, and something we've been talking about for a long time, to pursue the strategy of build to own for our income funds, which in the long run, it's going to help us build our portfolio with the desired asset classes in the target markets at returns that will be accretive to our funds. So for example, if two of the obvious asset classes that everybody talks about that have performed well through COVID are industrial and multifamily rental apartment. Well, it's challenging to buy new product of those asset types. So at cap rates that make sense. So we can buy older product and make it work, but the newer product, the cap rates are so low, it's not accretive to the fund. So we've made that concentrated effort and decision and direction to go forward. So here's a few examples. So these are all in our Canadian income fund. So starting in the top left, we have probably one of my favorites is a lot of people know it as Harbor Towers in Victoria. It was originally 50 years ago an apartment building, and then at some point it got converted to a hotel as an operating hotel. We bought it from BCIMC, and we continued to operate as a hotel until we got the permits, and then converted it. Once the permits were approved, we then converted it to a residential building. We basically stripped it down to the concrete. The building just finished in April. We're over 80% leased, which is amazing because we opened the doors April 1st. And this is a jewel in our portfolio. It's 2 blocks from the Parliament buildings, and this building is going to be a great performer for many years to come. In the middle, going across the top, we have the Rex, and it looks small in this picture, but there's actually 3 phases to it. There's 250 plus units. So this is very close to the Fraser Valley Community College, and basically across the street from the Abbotsford Arena. Just off the Trans-Canada Highway. So this project is just finishing now, and we're in the lease-up phase. So this is a great wood frame project. In the top right hand, there is a project called Oslo and Fifth, and this is in Sydney in Victoria, very close to the ferry terminal. Sydney is a really cool little town there, very close to the Victoria International Airport. And so we will be starting construction shortly on 75 units in a wood frame design. Going across on the bottom, starting in the left, We're in the pre-development stage getting our permits, but we're going to be building a multifamily rental building here in downtown Victoria. It'll be called the Spencer Block, and it'll be approximately 250 plus units. And so we're into the city for approval and hope to start on that sometime late next year. Also in Victoria, in Saanich, and so in the middle, Mackenzie and Shelburne, we have a property that's a 5-minute walk to the University of Victoria campus. The plan is to build approximately 500 rental units that could be suitable for student housing, but certainly available for rental accommodation, and we plan to have retail at grade. So again, we're into the city district of Saanich for approval to start construction, which we hope to start in the next 15 months. And then lastly, in Toronto, in Mississauga, we have an industrial property for just under 300,000 square feet. It's under construction. It'll be ready in September. We already, the vacancy rate for industrial space in the Toronto market is 1.5%, so it's extremely low. We already have several letters of intent inquiries, so we expect to have this property leased at or just before completion at the end of this year. So as you can see, we only, multifamily is very popular. We do have some other industrial projects we're doing, but this is just a sample of the projects we have underway with our team.
That's great. Again, thanks for all those examples. Switching gears a little bit here. So the value add fund, I think I saw, has 45 plus projects, all of which are at different stages. Can you give us an update on that fund specifically?
Sure. The value add fund, it's a lot of work. We currently have 45 projects, and they're all at, as I mentioned earlier, they're all at different stages of development, ranging from early planning to under construction to nearing completion and sold out. And as mentioned earlier, our strategy is for this fund is to build and sell or repurpose and sell. We've traditionally partnered with reputable and talented development companies who have a very specific skill set for a certain asset or in a certain market. So while there are different types of projects we have pursued, there are definitely certain types that we like a lot, such as the industrial strata condo is very popular, and the multifamily rental apartments are very popular as well. And so we definitely have a preference for those asset types. When we first started the Value Add Fund in late 2014, many of the fundamentals back then, such as construction costs or labor, materials, land prices, and for sure the time for approval from municipalities, you could rely on those. You knew what they were. But about 2 to 3 years ago, these fundamentals started changing, and we've seen labor costs rise, and materials are rising, with all the tariffs, and you've got land prices that have increased, and then you get lengthy delays for permits, longer than normal. And so there are a couple projects in our fund that have been impacted by time. But notwithstanding these challenges, our Nicola Wealth Real Estate team, we've continued to adapt, and we remain very confident that we can add new projects with valued partners that will be complementary to the overall return. In fact, I'm pleased to report that we've got, over the last 2 or 3 months, we've got several new value add projects that we've committed to, and more in the pipeline that we will be proceeding with. And these projects are expected to produce very solid returns for the fund.
Wonderful. So maybe we can talk a little bit about, the lessons we learned over the past 5 months, and maybe, when we start talking about acquiring properties again.
So I think the biggest thing we've learned is that you need a talented team with a diversified range of skill sets, and we've built a very talented team with of experts and that can help us execute. And I can't emphasize how important that is to have the diversity of skill sets. So, and secondly, I think we've gained a lot of data points on rent collection and how tenants behave, how assets have performed in certain markets. I mean, this is valuable information for us that it not only confirms our disciplined approach was the right way to go, but it also allows us, we're humble enough to make adjustments to our strategy to keep getting better. And thirdly, I think the level of our due diligence on acquisitions, I thought it was pretty good. In fact, we often polled many brokers after transaction to say on a scale of 1 to 10, how were we in due diligence? And they said, you're a 9.5 to 10, but you were fair. So I think in this process, it's going to go up a couple more notches. And the reason is, a good example would be on future acquisitions is, you can imagine all the talk about rent collection. Well, assuming that an investment opportunity meets all our typical important criteria, we're definitely going to want to know how those tenants performed during this crisis. So did they pay the rent on time? Did they require rent deferral, or did they default? I mean, that is going to ratchet up big time on your due diligence.
So maybe continuing on the theme of acquisitions, what are you and the team observing so far as you're exploring opportunities? And can you tell us a little bit about the process we go through to acquire a property?
Sure. The observations are very interesting, especially when you compare the US market to Canada. In the US, the results on how their government is dealing with COVID it's concerning. However, you would never know this by the amount of real estate activity that appears to be going on in their market. And it's almost back to their pre-COVID levels. Whereas I would say in Canada, there's a much more disciplined approach and conservative approach in dealing with COVID. So the investment activity appears to be definitely more cautious, on the cautious side. I think there's still several investors that are sitting on the sidelines, but it's each month, each week that goes by, you're seeing more and more people come back to the table. So one positive fact that we have observed for both Canada and the US is that tenants are willing to make lease commitments. And that's really encouraging, because if you're a real estate owner, you want to know that you can, if you've got vacancy, that you can lease up the space. So if leasing activity were to stall in this environment over the past 5 months, I think that would be a bigger cause for concern for investors to stay in the sidelines, but that has not happened. And I think I illustrated that a few minutes ago when I talked about all the lease transactions we've done. That's just a small sample of what our team has been dealing with. The other factor that is that even though we're only 5 months into this COVID era, we're amazed at the high volume of opportunities. And it's a positive thing that we've actually got more choice, and there's going to be a higher level of due diligence and discipline required to make sure that we continue to remain very selective. So to answer your question on process, for each and every new acquisition, in addition to our underwriting and our comprehensive due diligence, we also prepare an investment summary. And this is typically a 20-page document. And our team submits this to our internal, to the investment review committee for approval. And this investment review committee, or I call it the IRC, it's made up of 7 individuals, of which 2 of those people are outside real estate experts. So what I like about this process is that it ensures, firstly, that we have good governance, but it also ensures that all the senior executives at Nicola Wealth, they're up to speed on acquisitions, and they know what the direction we're going. So everybody's on the same page.
Thanks, Mark. Great to get a glimpse into the process on acquisitions. The final question before we get into the coming in from the audience. Does the upcoming US election have any meaningful impact on the real estate market in the same way that it might on the stock market? So, for example, in the stock market, there's a belief that, one party might be more conducive to, or a happier stock market than another. Is there a similar dynamic at play for real estate?
No. My personal opinion is that there is no direct correlation. The stock market is very liquid, but it can be unpredictable, and it will react in a much different way than real estate, which is not liquid, but can be reliable and predictable. So I would acknowledge that a Republican administration would probably favor enhanced tax policies that would benefit real estate. But we had a Democratic president for 8 years, from 2008, when that whole global financial meltdown started, up until 2016. And the US economy recovered and prospered. And the commercial real estate market, granted it took longer to recover in the US, it did recover, and then it performed very well before the Republican president came in. So I don't think the election is really going to change our thinking and strategy for the US based on who wins the election. I think what's more important is that we remain on course with our investment strategy and our disciplined approach.
Great. So we're going to get into the to the questions from the audience, excuse me. Before we do, where can our clients and listeners go to stay informed about the real estate funds, Mark?
Sure. So during COVID, there's no question that our team, Nicola Wealth Real Estate team, we've increased our client communication. So in addition to our quarterly reports, which we send out all the time, and then our annual reports, we've been really proactive with podcasts, with newsletters, and then webinars such as this, which will be recorded. And these will all be available on our website at realestate@nicolawealth.com. So I encourage people from the audience, if they want to access those publications, they should go there. And it also includes information on any new acquisitions that we do. So we try to stay current and keep our readers, our audience, up to date on for each fund.
Great. So the first question we've got here is, you mentioned a focus in the income funds on build to own. What percentage of the funds do you expect that component to grow to?
We have a max capacity in there, I believe, of 25%. I don't ever see us getting to that 25%. We monitor that very closely. And as I mentioned today, we're at around 6%. I think the comfortable range for us is in that 5 to 15% range. So I could see that going up in the next 2 years to the 10% range. But again, I want to give confidence to our investors that the type of assets that we are going to do are going to be very safe. They're going to be apartment buildings. People need to live somewhere. So apartment buildings are probably the safest asset class. Or it's going to be, say, industrial, which it would be in a market such as Toronto or Vancouver, where the vacancy rate is 1%. So we're really going to be careful and selective about what those build to own projects are.
Great. The next question. Not everyone is familiar with the concept of Strata Industrial. Can you provide an overview of a typical Strata Industrial project? And have you observed any change in demand for Strata Industrial units?
Sure. Probably the best example I can give is the very first one we did, and it's one of the early projects in our value add fund, but it was on Laurel. And we later realized how important that brand, that it was called Interurban with our partner PC Urban. So we branded it Interurban. So each one now is called Interurban Laurel or Interurban Rivershore or what have you. So the best way to look at it is these are condominiums for industrial users, and they're typically 2,500 to 3,000 square feet, where you'd have, and depending on the configuration of the site, you might have a rear load or a front load. And so, but either way, you would have a roll-up door that accesses your warehouse. And then in the front, you would have a showroom. And then upstairs, you would have a mezzanine office. But the bulk of the unit is an industrial warehouse. And the nice thing about these industrial strata condo units is that it caters to small companies like the concrete guy, the pool guy, the construction guy that has their business and can use their balance sheet to buy one of these units. But if somebody wanted, 5,000 or 10,000, they can just buy multiple units. And we've seen that. So when we market these projects, we find that there's a variety of buyers in terms of the amount of units. Some buy just one, some buy three, some buy five, depends what they need. But this quality of this product is at a level that not seen in our marketplace for smaller users. So it allows a small user to own his own piece of real estate, and it's got great liquidity.
Great, thank you. Given the multi Florida and Texas within the U.S. fund, what risks do you foresee with seems like a rising frequency of hurricanes, and what are the mitigation strategies?
That's a good question, because this time of year, and it's happening right now, those storms start rolling in to those states, and we watch that carefully, and that's why you have insurance. The last storm that came, I believe it was last summer, was pretty big, and of course we're monitoring the status. And I think we only had, of all our projects, 60 projects, we only had one that was actually impacted by water damage, and we're actually just starting a renovation, so it actually fit in well. I'm not sure what the mitigation strategy would be. I'm not sure how you can prevent against a storm. I mean, there could be any number of natural disasters that happen in not just those states, it can happen anywhere. So, but the point you raise is it highlights the importance of our insurance package, which tenants pay for. Obviously, that you don't recover it from tenants in residential buildings, but our insurance policy is big. And so we want to make sure we have coverage for those natural disasters. So I don't know if there's a strategy to prevent against natural disasters, but we monitor it and we're covered and we're not out of pocket.
Thanks for that, Mark. How, if at all, has the appetite towards residential projects in the Nicola Value Add Real Estate LP changed since the pandemic?
I assume you're talking about residential condo, versus say rental apartments. So definitely with the mortgage stress test that was put in, it's made it a lot more difficult for the average person to buy a home. What's helped though in the last while is low interest rates. So we definitely have adopted a very cautious approach. We have not approved any new condo projects in the last 2 years at least. We wanted to watch and see what happened. And then of course, COVID happened. And so we're watching. We are seeing a couple opportunities, whether it's townhouses or condos, but they'd have to be in strong markets such as say Toronto or Vancouver or Kelowna or Victoria, where we know that there's good demand. But we are following that market very closely to see what the buyer activity is, and it seems to be active right now. But we're not going to jump back in. We're going to be very cautious. We're going to be very selective, but there are a couple we are looking at.
Good. I think we might have time for two more questions. So the first is, how are you handling acquisitions outside of Vancouver, given the challenges related to traveling right now?
Yeah, well, on one hand, I'm glad I don't have to do as much travel. I traveled a lot last year. There's a couple things. One is we have very good broker network in all those markets that we're in. And the brokers are very resourceful. They know how to get to us. They see we're active. The real estate's a pretty small community, so they know how to access us. So, but the challenge that is in front of us right now is if we do see an opportunity, in another city. And so, for example, in the US, if I can't travel to the US, well, I can travel, but I'd have to come back and self-isolate for 14 days, which I don't want to do. We actually have very valuable partners, property manager partners who we trust them because they property manage the assets. So we are looking at a few assets in, say, Denver and Seattle, where we actually are asking a very trusted individual who runs their entire portfolio to travel to that marketplace and be our sets of eyes. You can film it, we can Google Earth, but you're right, in the short term, it's going to be a bit awkward and travel is going to be tough. As it relates to Canada, it's a little different. I can travel and I am traveling, but we also have an individual we've hired in Toronto that is on our team, very experienced. So that was an evolution eventually that we were going to get to. And as we grow, and that's now happened, which partly was caused by COVID, to have somebody in the ground there. And so because Toronto is such an important market for us, and it's obviously the biggest market in Canada, we need to have boots on the ground there. So we are building up our team there, as is the wealth management platform.
Very good. We've got time for one more question, and it's, what markets are you looking to enter or expand within Canada?
So we like this cluster strategy. And whether it's in the US or Canada, we have this concept of the cluster strategy. So I'll come back to Canada in a second, but certainly in the US, Seattle, Denver, Vegas, Phoenix, we want to have a critical mass there. You're far more efficient if you have a concentrated portfolio there. So in Canada, if you look at our portfolio right now, you'll see we have a large concentration in Vancouver, Toronto, and those two markets are always going to be our strongest markets that we want to continue with. They have good liquidity, and yes, they're expensive, but good liquidity, good tenant demand. So we're always going to be in those markets. We have not gone to the Maritimes. And I'm not sure we're going to. We could, but we're not planning on it in the short term. We haven't gone to Quebec, and we could, but we haven't. We do have assets in Alberta, as I referenced earlier, in Calgary, and they've performed well. But even though, save and except for, say, maybe a residential, which we might consider, I'm just afraid we're not going to be acquiring more properties in Alberta until we can get some clarity on their economy. So other markets we like that we're either in or we'd look at. We like Victoria a lot. It's a great market there. Kelowna, again, another burgeoning market. There's a lot going on in that marketplace. Winnipeg, good industrial market. We like that market. So Hamilton, another market we look at. It's really a suburb of Toronto, but when you look at the map of Canada, it's pretty skinny. There ain't a lot of choices. So for now, it's going to continue to be probably Vancouver and Toronto, and then some stronger secondary markets.
I think that's a good place to end it, Mark. Thank you to all of our listeners, and especially to you, Mark, for taking the time to provide your insights.
You're welcome.